Welcome, and thank you for sharing this time with us. In the next few minutes, you'll learn how a very special program provided by the mortgage firm can help you access money you never knew you had. Many seniors would like to remain in their homes and maintain their independent, comfortable lifestyles. However, this can be challenging as the cost of living continues to rise while most seniors' incomes remain at a fixed amount. As a result, the Federal Housing Administration searched for a way for seniors to access equity in their homes so they could improve their standard of living without the burden of monthly payments. The answer they found is what's known as a reverse mortgage, also referred to as a home equity conversion mortgage, or HECM. It is insured, regulated, and guaranteed by the federal government. A reverse mortgage provides a safe, flexible answer for any senior looking for extra income without affecting Social Security or Medicare benefits, and it's non-taxable. In this presentation, I will help explain exactly what a reverse mortgage is. We'll also talk about the many features and benefits of the program, as well as how you can qualify. In addition, I'll dispel some of the most common misconceptions you may have heard about reverse mortgages. So, what is a reverse mortgage? It is a federally insured home equity conversion loan instituted in 1989. Instead of making monthly payments, you may choose to receive them, essentially the reverse of normal mortgages. Here are some of the unique advantages of a reverse mortgage. It allows seniors over the age of 62 to borrow against the equity in their home without the burden of monthly payments. No repayment is due as long as the home is your primary residence. You may choose to receive funds in a number of ways and use them for any purpose you like, such as home repairs, travel, medical expenses, or to supplement your monthly income. And remember, this is completely tax-free. Approval is not based on your credit or income, as is the case with a traditional mortgage. And that's right. Your credit and income are in no way considered in qualifying you for this mortgage. And that's because you're not obligated to make monthly payments. This loan is based solely on the equity in your home. If you invested $30,000 30 years ago and then watched it grow to $300,000, you wouldn't think twice about accessing that money in your retirement years. So why should the equity in your home be any different? Let's review the guidelines. You must be 62 years of age or older. The home must be your primary residence. It can be used on single-family residences, condos, townhouses, or manufactured homes. Second homes and investment properties do not qualify. Your home needs to be paid in full, or have a mortgage balance that can be paid off with the proceeds of the reverse mortgage. You are still responsible for payment of homeowners insurance and property tax. Remember, there is no income or credit rating required for qualification. You can even qualify if you filed bankruptcy, as long as it's been discharged. The amount you can receive depends on 3 factors. First, the age of the youngest borrower. The higher the age, the greater your proceeds. If you are within 6 months of your birthday, the program will round your age up. Second, the appraised value of your home. The higher the appraised value, the greater the proceeds. An FHA-approved appraiser will inspect your home and assign a value based on what other similar homes in your neighborhood are selling for. Other factors taken into consideration are the size and condition of your home. And finally, the interest rate. The lower your interest rate, the greater your proceeds. The FHA HECM is tied to the U.S. Treasury bill, so in comparison to traditional mortgages, interest rates on reverse mortgages do not vary from company to company. With a few minor exceptions, closing costs are also consistent. The income this mortgage provides can be accessed in a number of ways. Option 1. Receive the equity as monthly income for any term of your choice. For example, you may choose to receive the income for a period of 10 years, 20 years, or for life. Option 2. Receive a home equity line of credit. This option allows you to take as much money as you need whenever you need it. Remember, there are no payments due on a reverse mortgage line of credit. A home equity line of credit is the most popular option because it allows you to access additional funds on your credit line year after year as your home appreciates in value. Option 3. Receive a lump sum payment. This option is typically used when the need for money is immediate, but is not recommended to be used to purchase investments or annuities. Option 4. Choose any combination of the previous options. Regardless of what option or combination of options has been chosen, no interest is charged on unused funds. Let's take a look at a few examples so you can see these options being applied in a practical situation. Mr. and Mrs. Fielding are both 70 years of age. The Fieldings' home is worth $200,000 and they own it free and clear. They could obtain a reverse mortgage and receive tax-free income of $716 a month for life. Another option would be to obtain a line of credit for $118,128. Mr. and Mrs. McCormick are also seniors in their 70s. They owe $50,000 on their home, which is valued at $200,000. They could obtain a reverse mortgage, pay off their existing mortgage, and receive tax-free monthly income of $412 for life. Besides this monthly income, they would also be eliminating their current mortgage payment of $515 a month, or they could receive a line of credit for $68,128. I know, you may be thinking that this program sounds too good to be true. After all, how is it that a senior can remain in the comfort of their home, rid themselves of any current mortgage payments, and in fact, receive tax-free income for the rest of their lives? Well, it's all made possible with an FHA federally insured and guaranteed reverse mortgage. This mortgage is often misunderstood. So let's review some common myths and misconceptions. Myth 1. The bank will own and take over the title to my home. That's false. Many seniors overlook reverse mortgages because they assume they will no longer own their home. You will always retain the title to your home, just as if this were a traditional mortgage. You will never be asked to leave your home. If you decide to sell your home, the mortgage will be paid off with the proceeds of the sale. Any remaining equity will go straight to you. Myth number 2. My heirs will not be able to keep my home. False. Once the home is no longer your primary residence, the reverse mortgage would be paid off with either your heirs refinancing to a traditional mortgage or with the proceeds from the sale of the home. All proceeds over and above paying off the reverse mortgage would go to your heirs. Myth number 3. I can owe more than my home is worth. That's false. An FHA reverse mortgage is a non-recourse loan. This means that you can never owe more than the value of your home. Remember, this fact is guaranteed by the federal government. By now, you may be thinking that this unique, safe, and flexible reverse mortgage is right for you. We encourage you to share this video with family members as well as anyone else you trust, such as your financial advisor, CPA, or attorney. Here at the Mortgage Firm, we are excited about offering this life-changing mortgage. We are committed to making sure you understand every aspect of this program, as well as all the options available to you. Most of our consultants at the Mortgage Firm have over 20 years of experience in traditional and reverse mortgage lending. Please call us for a free, no-obligation consultation to see what you may be eligible for. We will even be happy to meet with you in the comfort of your home. Thank you again for sharing this time with us. We hope to have the opportunity to work with you. The Mortgage Firm. Mortgage solutions with a personal touch.